M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half now.
But no recession yet.
Rolling recession. Housing, by some measure. Sales, down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary, and that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the US, minus 3.8.
For months, Americans have been gripped by the looming threat of an oncoming economic downturn. Rising inflation, job layoffs in specific industries, and declining real wages have created financial challenges for many, making it difficult to meet essential expenses. Simultaneously, the job market has shown resilience with historically low unemployment rates, sparking discussions among economists about the concept of a rolling recession. In a recent interview, Cathie Wood, CEO of ARK Invest, shed light on this economic paradox. She pointed out that certain sectors, such as commercial real estate and basic consumer manufacturing, are already in recession, while others remain strong. Wood highlighted the Federal Reserve's attempts to cool the economy through rapid interest rate hikes to combat inflation, a strategy facing complexities and potential long-term impacts on various sectors. Wood underscored the far-reaching consequences of interest rates, noting that they impact everything. Smaller and medium-sized companies with capital needs find themselves disadvantaged, potentially leading to constrained growth, layoffs, or even closures. In an upcoming video, Cathie Wood will share her macroeconomic outlook, expressing her view that the Federal Reserve's strategy is unfortunate.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We're getting more proof of concept on deflation too. So it starts at the commodity level, always does, right? Copper prices peaked at $5. They're now about $3.50. Oil even, is down to, well, it's in the 70s, but even more interesting to us is gasoline is pointing to much lower oil prices. The demand destruction in gasoline right now, because of the pricing, is so high. I think gasoline demand, was it around the Labor Day holiday, hadn't been this low in 25 years, something like that. Big demand destruction in all kinds of categories, including staples. Now, the Procter & Gamble's and staples companies, they took full advantage of supply chain crisis and jacked prices up. Guess what? Their volumes are falling. That is not a good recipe for a manufacturing company. You want to keep your manufacturing plants running full time. And now they're seeing a pullback in unit volume. We're seeing in the S&P 500, about a third of the S&P 500, a third of the companies are showing falling revenues. Falling revenues. That means the combination of units and pricing, that combination is down. If you look at commodity prices as measured by the Bloomberg Commodity Price Index, they are today where they were in the early 80s. They've gone nowhere.
Well,
M2 growth has been negative all this year on a year-over-year basis. The yield curve has been inverted all year, actually almost a year and a half now, roughly a year and a half now.
But no recession yet.
Rolling recession. Housing, by some measure. Sales, down 40%. That's a recession there. Auto sales, 15 million units. That's recessionary. Falling prices as units fall, that sounds recessionary, and that's happening in staples. Home Depot today, sure, it was one of the biggest beneficiaries, but it's been 2 to 3 years now, and it's still saying minus 3% same-store sales growth. That's both price and profits, and deeper negative here in the US, minus 3.8. So I'm looking at statistics and I'm listening to earnings calls. When I listen to earnings calls, and I listen not just to ours, but to other more cyclical companies, just to get a sense of the economy. You listen to them and you'd think we're in a recession. Now, it depends on the area. We're in today's CPI, you saw auto prices coming down. You saw airline prices coming down. So you saw education prices coming down. Oil and energy, transportation we knew about. Rents, the pop last month reversed. Didn't go negative, but in the real world, we're hearing about serious rent declines or serious discounts, like 6 months free or 1 month or 1 year free. So I think it's all around us. The Fed is paying attention to lagging indicators. One is the CPI. It's gone from 9 to now roughly 3. We think it's going to turn negative before all is said and done. The other one is employment. Now, what the heck is going on in employment if what I just told you is true?
Right.
We know how many companies had such trouble finding anyone as we were coming out of COVID. They're reluctant to fire people even though their margins are starting to fall, so they don't want to go through that again.
Right.
If their margins do get crushed, as we think they will, as they lose pricing power,
then you could see more rapid.
An economic recession occurs when the overall output of an economy contracts instead of expanding. Typically, this contraction is assessed through changes in gross domestic product. A rolling recession, however, is a distinct type of economic downturn that does not uniformly affect the entire economy. The unique characteristic of a rolling recession becomes apparent as it selectively impacts different market sectors at different times. Unlike a conventional recession that affects the entire country simultaneously, a rolling recession manifests by sequentially affecting specific areas or industries. This nuanced dynamic means that while the overall economy may not be in a recession, individuals in certain regions or specific sectors might perceive themselves to be in one. To illustrate, instead of a recession hitting the entire nation at once, it unfolds gradually, impacting certain parts at distinct times. Some segments of the economy may even escape the downturn entirely. In her macro outlook, Cathy Wood delves into outer macro factors and shares her perspective on the future trajectory of the economy.
This year has been a tale of two markets. Through July, it was risk on. Why? Because the market was seeing surprises in terms of oil prices coming down, auto prices coming down, and saying, oh, the Fed must surely be done. And then we get a CPI print or a PCE print that disappoints, and the Fed continuing to say, oh, no. Well, higher for longer, and we absolutely will raise interest rates if we cannot see 2% inflation. So I think they're in the process of making a mistake. But in the beginning of the year, people were saying, okay, the numbers are coming down, inflation's, doing what it should do. Then we had this pause where, are we stuck here at 3 to 4%? Many people think we are because they see these wage hikes going through, 10% per year, 6% per year. And they say, surely we're back in a 70s style inflation. And that, that's what the Stanley Druckenmillers and the bears out there are thinking. We think that is absolutely wrong, that the resolution of that 10% push in wages per year will end up in lower margins. Big problem, not in higher prices. Big difference, very big difference. And so I think it's from the end of July through, really it was through the end of October, we went through this big nervous period where the long bond yield started rising relative to the short-term yields. Still an inverted yield curve, but long yields were rising. It was a bear flattening, not a bull flattening. A bull flattening is when short rates come down relative to long rates. So a bear flattening went risk off. People sold our strategy. Sold anything risk off and moved back to their benchmarks, moved into cash, huge amounts of cash on the sidelines. Now we're getting more prints again that are saying the Fed probably has overdone it. And you just listen to quarterly company calls and you'll listen to these management teams, and we have lots of callbacks with managements, and they say, why are you the only one seeing recession? Why can't the Fed see this? This is what we're going through, just on the expectation of rates going up. And then on the reality of rates going up, we were crushed in 2022. The market has discounted what the Fed has done. I don't think the Fed's going any further. If the market can feel comfortable that that is indeed the case, We don't have to have rates even come down. We think they will, but we think that certainly our strategy has discounted the worst. I don't think value stocks have discounted the worst of the cyclical part of the recession. We tend to be recession resistant. The last leg here is going to be consumption. And we'll see how the holidays fare, how deal-driven consumers are. We think they're really deal-driven.
The Eurozone finds itself in the midst of what seems to be another recession. Concerns linger about whether upcoming growth figures in the early months of the next year will be positive, negative, or missing altogether. Looking beyond these immediate uncertainties, the positive aspect is that the 20-nation currency union is poised to sidestep a severe contraction that could leave lasting scars on firms, households, and banks. However, the downside is that growth is teetering around zero, lacking the momentum needed for a substantial recovery. Formidable economic headwinds indicate that the challenges will persist into the next year, with the Eurozone struggling to expand by more than 1%. Despite potential for a robust rebound, deep structural issues suggest that Europe is likely to lag behind other major economic regions for years to come. The short-term outlook, as of the data presented on Tuesday, indicates a 0.1% contraction in gross domestic product from July to September, pointing towards a shallow recession if early indicators for the fourth quarter hold true. Despite optimistic views that demand will recover, fueled by rising real wages and a tight labor market, skeptics argue that high borrowing costs, a softening labor market, and subdued overseas demand may hinder the confidence rebound that the European Central Bank is banking on. As Europe heads into a year where both monetary and fiscal policies aim to curb growth, the overall economic outlook appears bleak beyond the next year. Share your thoughts on whether we are witnessing a rolling recession or a full recession in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.